So have you ever back tested a strategy and seen it works really good until the market gets choppy? For example, let's say you trade an EMA pullback strategy. It works really good in trending markets, as you can see, but as soon as the market gets choppy, that's where the win rate starts to drop dramatically. And that's why in this video, I want to break down not only how to identify chop, avoid chop, but also there's one rule I use to only take high probability setups when the market is least likely to chop around. This is what I use in my own trading. With that being said, super excited to show this to you guys. Let's dive straight into it. All right, so what exactly is chop in the market? So as you can see, this is a clean price action day. Okay, we can see we have a clear trend where we're going up, pullbacks are getting bought up cleanly. There's no stop loss hunting, there's no manipulation. It's just a clean trending market. This is going to be a very easy day to trade in the markets. And then we look at just 2 days before that, we can see a market like this where we're constantly chopping back and forth. The pullbacks are not getting bought up. It's not sustaining any buying. It's a very balanced market, right? Every time we go up, we equally go back down. Every time we go up, we equally go back down. This is going to be a lot harder to trade on a day like this. So first thing I want to go over is how to identify this chop. Okay, so there's 3 things I like to do. The first thing you want to do is you want to make sure you're trading at the right time of day. Okay, this is super important. I see a lot of traders, they try to trade the whole 6 or 7 hours that the market is open. And really that's where you can run into trouble. I guarantee if you look at your past 50 winning trades, you'll see most of them came during a certain time period. So for me personally, that time zone is 9:45 a.m. Eastern time to around 10:30 a.m. Eastern time. Okay, so that's literally a 45-minute trading window where my best trades happen. Now I will take trades outside of that time zone, but I really don't like to go past, 11:30 a.m. Eastern time, because that's when the market starts to die down. It starts to get more choppy, and half the time the market already made its move for the day. The big players already made their positions, and then it's just kind of doing whatever it wants. So time of day is super important for identifying chop. Next thing I want to look at is I want to see, are we in a tight range, right? Did pre-market have a tight range? Did the first 15 minutes of the market open have a tight range? Okay, so that's another thing you want to pay attention to. And the last thing to really identify chop, this is kind of an optional one, but it's something I like to look at, is the EMA compression. Okay, so if you use a simple EMA tool, I like to use this on the 15-minute time frame mainly. So for example, if I pull up the 15-minute time frame on NASDAQ, I like to use this EMA bundle. So if you just type in EMA, you'll see it on the indicators. It's a 20, 50, 100, and 200 length. And it basically just stacks them all together. Again, I use this on a 15-minute time frame. So we can see, for example, when we had a nice trending day like this day, right? What do we notice about the EMAs? Let me just move myself here. The 21 EMA is in the front, the way it should be. The 50 EMA is behind it. The 100 EMA is behind that. And the 200 EMA is down here, right? They're all in order, and they're all have a nice equal distance apart. Right? Even before the market opened, you can see they're all kind of moving in the same direction. They all have a clear trend. This is a good sign that the market can trend that day. Versus if we go to some of the previous days where, see how they're all cluttered right here? And again, we can look at this before the market even opens, right? Right where my screen turns black, that's when the market opens. So we can see, look how cluttered they are. They're all kind of, sometimes they'll be mixed together. They won't be in the right order, and they're just very tight, right? This is typically when market will be more choppy that day. It's a very easy little rule you can look at. Okay, we can go to the next day. We can see they're even tighter right here. They're very compressed. We can see what happened that day. It was a very choppy market. So this is a very helpful tool you can use to actually identify whether the market's going to be choppy or not that day. Also, real quick, guys, before I forget, I want to invite you to join our free Discord community. Inside of here, I post my trading plan every day on ES and NQ, and I kind of show where those tight ranges will be, where I'm interested in longs. So for example, today I said I'm mainly interested in longs if we hold above 22,915, right? And you can see all my levels on the chart. I do the same thing for ES. We have an awesome community of all kinds of, unprofitable traders, profitable traders, traders with years of experience inside of here that you can chat with and, just get some help from. So anyways, guys, if you want to join this community, we'd love to have you inside. It doesn't cost any money to join us. It's completely free. all you have to do is go over to the first link in the description below this video. You'll be able to join this community for completely free. Now, once you identify the chop, how do you actually avoid the chop? Well, to avoid the chop, what I like to do is I want to wait for the break of the range. All right, so for example, if we go over to ES, for example, I like to trade NQ and ES futures. We can take a look at the range this day, right? We can see the pre-market lows, I'll just draw a horizontal line, was around right here. We had a lot of consolidation in this area. This is near the bottom of this range. Now we can see as soon as we broke that range, because before we broke the range, yeah, we were trading down, but we're kind of choppy. We weren't very sure what we're gonna do. As soon as we broke that range and started retesting that level, right, that's when the market had a little bit more of a clear trend. And this is where, you know, some of my signals started going off for my indicator. And one of my favorite things to do is just to mark the 15-minute opening range. You might have heard this before online, the orb, right? It's the first 15 minutes of price action, the highs and the lows of the first 15 minutes. That's this red line and the green line. Marking these levels works pretty well too. So for example, we can go to the previous day. This is 4th of July, so I don't even trade holidays. But we can go to this day, for example. We can see, you know, this is obviously an easy day to trade. It was just trending up. But you can see we didn't really have a tight range. I mean, the only tight range we had was this pre-market high, right? And before the market even opened, we broke through this high, right? So really on this day, you almost don't even need an opening range because we already broke through, you know, that tight range. So it was kind of like clear sailing from here on out, right? You got to think of all the choppy price action as like traffic on a freeway. Once you get through the traffic, right, then it's going to be a lot smoother drive, a lot smoother trend. That's another way you can kind of think of it. We can go to this day, for example. We can see market was pretty choppy the first 15 minutes, and then all of a sudden, right, once we broke the 15-minute range, then we started trending up pretty nicely. So if you want to look at nothing else and just look at one thing, I would use the 15-minute range. That works pretty well for avoiding chop. Now, the last thing I want to talk about is how to spot a high probability setup. So one thing that was happening to me last month was, you know, let's say we would kind of chop around. We'd chop around right when the market opens, I'm talking. Then we get this explosive move up, right? And we pull back, let's say once, right? And we break out of the opening range, let's say, we pull back again. Then what was happening, like especially last month in June, was we literally just stop. Okay, so like this is the first 30 minutes of price action. We chop around, get a huge move up with a few pullbacks. Then we'd act like we're pulling back again, right? And then we'd chop around the rest of the day. Now, if you miss these first, you know, this first pullback or even the second pullback and you're getting in up here, this is where you're getting screwed a lot, right? And this was happening to me a lot, was I was missing the majority of the move, right? I was avoiding the early chop because I was waiting for us to break out of that range, right? Kind of like I said over here. But then I was getting in too late because the market already made its move for the day, and now we're just kind of just chopping around the rest of the day. So a rule of thumb that I like to use for my trades and for my setups is you only want to take the first pullback after the trend shift and avoid the rest. Okay, the first pullback is going to be the highest probability. The reason being is if we do have that explosive move up, right? For example, let's say we go like this, by the time the second or third pullback happens, right, everyone starts to notice the pattern. Okay, it's like, oh, every time we pull back, we seem to go up. And once too many people notice the same pattern, that's when it stops working. Okay, so you got to be the first one in. You want to be on the first pullback before everyone else notices the pattern that's happening. That's going to be the highest probability setup, and there's probably going to be more juice in the move, right? It's probably going to have some more juice in it left if it only pull back once. So for example, I can go over to the charts, over to NASDAQ, and we can see, and this is going to be the same for anything you trade, that the market opened up here, right? We got our first explosive move, and we really didn't get a pullback until this area right here. And notice right here, we got this buy signal, and this was technically the first pullback we got of that move. So even though we were overextended because we went up a lot, right? We went up a lot the day before and over pre-market. The market was very overextended at this point. I decided to still take this trade because this is technically our first pullback for the day, right? If this was our second or third, then I probably would avoid this. And you can see after that, right, what happened? We pulled back again. There was more buy signals from my indicator, but I did not trade these because it was too late, right? People already noticed the pattern. Okay, so that's one example. We can go back to another day, and this is a more trending day. You can see, what was the best move of the day? Well, really the best trade of the day was this first pullback we got, right? Market opened up and we got this pullback. So really any of these two pullbacks where we haven't moved up too much, if you want to wait for the range to break, the 15-minute opening range, this would have been the best entry, right? Now, by the time we got way up here, we pulled back, 1, 2, 3, 4 times already. This is where the market started to get choppy, and this is what I'm talking about. And again, this is where it can get kind of dangerous, right? So this is a hard rule I have where, if we already pulled back a few times, I don't want to trade the signals. I don't want to trade the strategy. Whatever strategy you use, it doesn't matter. But the whole point is don't get in too late, okay? You can see examples of this pretty much, every day in the market, right? As you can see, we get the morning beginning chop, right? Kind of indecisive what we're going to do. Then all of a sudden, we get a big move down. And what do we see? The first pullback was the best trade of the day, right? It's going to have the most volatility. It's going to have the cleanest move. It's going to have the most juice. Okay, so for example, we go short right here. We can take it down. Now, obviously, we pull back again. We got another clean move down. That was the second pullback. From there, that's where the trend started to shift, right? And the market got more choppy. So that's my rule of thumb I like to do. That's one of the most important things I think that will help you guys the most is literally just take the first or second pullback after the trim shift and avoid the rest. This alone is going to help you out a lot with whatever strategy you're trading, whether you're using my indicator or a completely different strategy, it doesn't matter. So anyways, guys, this is my guide on how to avoid chop and only trade high probability moves. I hope you guys found some value out of this. Like I said before, if you guys want to join our free Discord community, we'd love to have you inside. Like I said, I post my trading plan every day in here. I post my trade recaps. And we also have an awesome community with all kinds of other traders. And we all kind of just help each other out in here. So anyways, guys, if you want to join it, all you have to do is go over to the first link in the description below this video, or just head over to this link right here. That being said, guys, as always, I hope you have a great rest of your day, and I will see you in my next video with another day trading lesson.